So the market was screaming and banging on the door of the Fed saying, you got to do something, you got to do something. And what became known as the Powell pivot, the Fed changed its tune. What you're seeing here are some notes from the Federal Open Market Committee. In the September 26, 2018 meeting, they said, hey, we're going to raise rates 3 times in 2019 and once beyond. That changed in December, about 5 days before that big dip. And you can see they said, oh, it's only going to be twice this time. And again, further in March, an increase of only once in 2020 is what they said. So they have been listening. The market, though, actually feels that they should have 1 decrease in 2019. That's what the market's pricing in right now. And back in March, that was a 60% chance of that happening. That's come down to about 23% today. So what was the Fed worried about? What was Jerome Powell and the Fed worried about? Again, the gray bars here, they represent periods of recessionary times. And what you're seeing here are 2 lines. The blue line is your natural rate of unemployment that exists in the US market. And then the rust-colored line is your civilian or unemployment rate that gets reported. What you can see again, the moment you break that barrier, what happens? Unemployment falls below that natural rate of unemployment, putting pressure on wages, reducing corporate earnings. Oh no, there may be a recession down the road. Now again, the current gap today is 1%, and let's keep that in mind as we look back in history. Unemployment recently touched down a nearly 50-year low. Wall Street Journal currently estimates that only 50,000 jobs are needed just to break even. The most recent report was 263,000 jobs in April. March was 198,000. So there's a lot of concern in the market that we're starting to get overheated in terms of that scenario. And let's look back on 2 previous recessions and times when this happened. Spoiler alert, it doesn't end well. Let's look at some history here. So what you have in the white line is the S&P 500 during the recession, 2001 recession. The green line is the unemployment rate or the employment rate. The natural rate of unemployment back then was 5.2. Today it's 4.5, so we put that in there. So what you had was a gap of 1.4. Remember, today we're at 1. 2001 recession follows. 8 months GDP is a little weak. Market falls from peak to trough about 47%, almost half of it. So it did create that bubble scenario. Let's go back a little bit in time to 1973-75 and look at that recession. Again, we're going to put the natural rate of unemployment in at 5.2. The green line is your unemployment rate at 3.4, a bigger gap of 2.4. And what followed, some of us might remember, is the 73-75 recession was severe. 16 months, lost productivity, negative 3.6%. More importantly, and just as crippling, was inflation ran up 12%. S&P 500 pretty much wiped out all the previous gains. So it's important to look back on history and understand what is concerning the Fed and why they're unsure which way to go. So when you look at the Fed and their financial forecast, they got a lot of things to look at. They want to look at the experience of 73-75 recession. They want to make sure that inflationary expectations are one of those things. Right now, inflation is not a problem. In fact, it's only beginning to reach the 2% target, and that is the Fed target is 2%. And you can see it's just reaching that now. So the concern with the Fed is, in trying to prevent or delay a recession, if the Fed does not raise rates, they may make this a worse recession. So do I let this market run on a little bit, let this economy keep going, and possibly risk a much deeper recession? Or do we raise rates right now and create a recession in 2020, but just keep it muted, if you will, relatively speaking? So Fed wants to look at that 2%. The market's listening. So the Fed forecast reminds us very much of a weatherman, Steve Carell and Anchorman. It's going to be 6 degrees and sunny. Or maybe it's going to snow. So when we look at the Fed and what it's doing, that gives us a backdrop for many things. One of the things we've talked about, though, is interest rates, debt, and so forth.